people. Well, hello, welcome back. So now we'll be revising IND AS 21 effects of changes in foreign exchange rate with the help of our chart book. Okay, so this particular standard gives us a guidance if you have done any foreign currency transactions and if you have any foreign subsidiary, foreign associate, etc., how to do the translation. IND AS 21 gives the guidance. Okay, first there are three types of currency as per IND AS 21 goes. One is your foreign currency. Foreign currency means any currency other than functional currency. So that means what is next type? There are three types of currency which IND AS 21 talks about: foreign currency, functional currency, presentation currency. Foreign currency means any currency other than functional currency. Functional currency means currency of primary economic environment under which your entity operates. Presentation currency means the currency under which you present your financial statements. The currency in which you prepare and present your financial statement is presentation currency. The key word here is the functional currency. Functional currency means the actual definition is the currency of primary economic environment under which you operate, or in layman terms, the currency which you're concerned about, the currency for which your heart beats, we used to tell in our class. Correct? No. Yeah. That means what, sir? Simple now. Now I'm in India. Correct? So I've been conducting all my classes. Obviously, I'm giving CA coaching means I'm getting fees from it. Yes. So all my expenditure I'm incurring in Gandhi note, Indian rupees. My income is in Indian rupees. That means will I be bothered about other currency? No. My heart beats for which currency? Indian rupees. So that means for me, Indian rupees is a functional currency. So what nonsense, sir? You are in India, so functional currency has to be Indian rupees? Not necessarily. Let me alter my example. Let's say I'm not teaching for CA students. I'm teaching for US CPA students. US CPA students. All my income I'm getting in dollars. All my expenditure if I'm incurring in dollars. Now my heart will beat for which currency? Not Indian rupees. It will beat for dollars. Yes or no? Just because I'm in India does not mean functional currency is INR. I can be in India and my functional currency could be something else also. Functional currency means the currency in which you basically operate under. There are certain indicators through which you can decode what is your functional currency. Okay, functional currency, what are the indicators? First two are primary indicators, another one is secondary indicators. First is functional currency is that currency in which sales are made. Functional currency is that currency in which purchase and other costs are incurred. So currency in which you incur make your sales and incur your cost, that is your functional currency. And other factors are currency in which you raise your loan. If you need loan, if you raise your funds in what currency, you make your investments in what currency. Thus there are other parameters. So keeping these things in mind, an entity will determine what is the functional currency for them. So take the notion out that just because you're in India, Indian rupees is functional currency, not necessarily so. That is one. Okay. All right. Next is, sir, if you have done any foreign currency transactions, right, you need to convert. So before you convert, you need to know what sort of a foreign currency component you're dealing with. A foreign currency component are broadly classified into monetary item and non-monetary item. Monetary item means those items whose value is fixed or they are expressible in fixed denomination of currency, we say. Monetary items are those items which are expressed in fixed denomination of currency, or in simple language, the value is fixed. Like let's say I've sold goods to debtor worth 1 lakh. How much money I'll receive? 1 lakh. So that means debtor, creditor, cash in hand, cash at bank, loan given, loan taken. All these are examples of monetary items. Okay. Non-monetary item means the value fluctuates, meaning value is not fixed. Like property, plant and equipment. If I purchase PPE for 10 lakh, its value will be after 2 months or 3 months or 2 days, it will be same. No, value changes. Yes. So PPEs, intangible assets, investment properties, inventory, investments in equity shares, all these are non-monetary items because their value fluctuates. Fair enough. Why do we need to know? Because the different exchange rates are applicable on them. That's the reason. Even equity, reserves and surplus and all are non-monetary items. Okay. All right. Now, sir, simple. Whenever you're doing a foreign currency transaction, simple rule is what IND AS 21 says is whether it is a monetary item or a non-monetary item. Transactions, if you have done any foreign currency transaction initial accounting will always be as per transaction date ka spot rate. TDSR we used to refer in our regular class. Yes. So if you have done initially, let's say you have taken a loan is a monetary item. So it will be converted. If you have taken a foreign currency loan, let's say $1 lakh, you can't record it at $1 lakh. You can't pass journal entry for $1 lakh. You need to convert. That conversion will happen at transaction date ka spot rate. If you have taken a loan, today's exchange rate you use and convert it. That is your transaction date ka spot rate. Okay. The same is hold good for monetary and non-monetary item. Initially all transactions at transaction date ka spot rate. And when you are doing any settlement, if you're repaying the loan, if you're repaying the creditor, etc., all settlements are recorded at settlement date ka spot rate, SDSR. Settlement date ka spot rate. Transaction at transaction date ka spot rate, settlement at settlement date ka spot rate. in between this transaction and settlement, if you have any balance, like let's say you sold goods to foreign currency debtor, you sold it on first let's say February 2025. You're going to receive the money on, let's say, 1st June 2025. You sold goods on this date, you will receive money. This is a sale date, this is the money receipt date. But in between these two dates, there is one important date. Your year is ending, which is 31st March 2025. So in between this settlement or between this transaction and settlement, if you are closing your books, then at what value this foreign currency debtor should be shown in the balance sheet? Because you have sold it and you are already converted, correct? At what value should this foreign currency item should get reflected in your balance sheet? Okay. For that, we say if you have any foreign currency balance between this transaction and settlement, if settlement happens after the balance sheet date, so foreign currency item will have a balance. Now you need to check what sort of a foreign currency component is this. If it is a monetary item, then you will have to remeasure. Already you have converted it to Indian rupees initially only, but this monetary item should be reflected in the balance sheet using closing rate. You have used TDSR, right? Same rate cannot be shown in the balance sheet. This monetary item should be shown in the balance sheet. Every monetary item should be restated and it should be shown in the balance sheet at the closing rate. And obviously, when you restate, you will get some gain or loss. That gain or loss will be transferred off to P&L account. However, if this foreign currency balance is a non-monetary item, then you need to check how is this non-monetary item valued. Like PPE, for example, if you have let's say plant and machinery, that plant and machinery either can be valued under cost model or revaluation model. If you are valuing under cost model, initially when you purchase this asset from foreign country, you would have already converted from foreign currency to Indian rupees. So if you are valuing this particular asset under cost model, no need to remeasure. Already on the transaction date, you have converted using TDSR, you have already converted. Show the same in your balance sheet. Obviously, if there is any depreciation, you need to reduce all that. That is usual process. Remeasurement of those non-monetary items which are already valued at cost is not necessary. Whatever you have used initially, whatever your transaction rate, spot rate, whatever you have used, continue with the same thing. No restatement is necessary for those non-monetary items valued at cost model. However, if you're going for revaluation model, for like PPE, you can go for revaluation model. Inventory, you can go for net realizable value. Yes or no? So if you're going for fair value model, then normally you do this fair valuation at year end. So the day you did the fair value, that day ka exchange rate you have to use and you have to restate. TDSR will not work out. If you're using fair value, the day you are finding out fair value, that day ka exchange rate you need to use and you need to remeasure. That means you will get some gain or loss. Okay. This gain or loss is accounted as per the respective IND AS. Meaning IND AS 16 says what? If you do revaluation and if you get revaluation gain, where will that revaluation gain go to? Revaluation surplus. That means if revaluation gain is going to revaluation surplus, even the exchange gain also will go to revaluation surplus. Suppose you did revaluation loss. First time you did revaluation and if you get revaluation loss, where would you transfer this revaluation loss to? P&L. That means exchange loss will be transferred off to P&L. So whatever you're doing as per the respective IND AS, the same treatment you will give it for exchange loss also. That's this particular component. Okay. So simple funda. This is about foreign currency transaction. If you have done any foreign currency transaction, initially all foreign currency transaction, doesn't matter whether it is monetary or non-monetary, everything will be recorded at transaction date ka spot rate. Settlement will be done at settlement date ka spot rate. In between this transaction and settlement, if foreign currency has a balance, if balance sheet date comes and if foreign currency component have a balance, you need to check what sort of foreign currency components are these, whether they are monetary item or non-monetary item. If they are monetary item, though you already converted, you need to restate them using what rate? Closing rate. That means you will end up getting some gain or loss. That gain or loss you need to transfer it to P&L. However, if it's a non-monetary item, check how it is valued. If it is valued under cost model, no restatement is necessary. So no further gain or loss will come because on the transaction date itself, you already converted. Same thing you can show in your balance sheet. However, if you're going for fair value model, then the day you found out fair value, that day ka exchange rate you need to use and you'll get some further gain or loss that needs to be accounted as per the respective IND AS. IND AS 21 takes a backseat there. So that's all is about this. Okay, sir. Okay. Next is what you need to know is what is a foreign operation. Foreign operation I'm referring to here as FO. Foreign operation means it could be a subsidiary, joint venture, associate or any branch. Okay. That is either located in a country outside that of the reporting entity or that is operating in a currency other than that of the reporting entity currency. Sir, what does that mean? Sir, suppose the parent, let's say we're talking about parent. Parent is there in INR. Parent is there in India. Okay. We have a foreign subsidiary. If we have a subsidiary, let's say that subsidiary is operating in US. That means this subsidiary, we call it as foreign operation because this is your reporting entity we are talking about. If reporting entity is there in India and if subsidiary is there in another location, subsidiary is not there in India but in another location, okay, then we say another country, yes, another country specifically, then it becomes a foreign operation. That is one way. Or let's say parent ka functional currency is Indian rupees. Parent ka functional currency is Indian rupees. Subsidiary ka functional currency. Let me modify this example. Let's say subsidiary is not there in US. Let's say they're in India only. Subsidiary is there in India only. But their functional currency is not INR. Their functional currency is, let's say, US dollars. In this case also, the subsidiary will become foreign operation. Rare case, but it could happen. Because I told you, just because you're in India does not mean your functional currency is INR. It could be different also. Yes. So foreign currency, foreign operation has been defined from two parameters. One, if you're operating in a country other than that of reporting enterprise, or if you're operating in a currency other than that of the parent, other than that of reporting entity ka functional currency. Basically, if parent ka functional currency and subsidiary ka functional currency, if it is not same, then it becomes a foreign operation. That's what we mean. One is country wise, another one is currency wise classification of foreign operation is being done. Okay, sir, when can you say subsidiary ka? Sir, there are some parameters which you used to study in your AS 11 as integral foreign operation and non-integral foreign operation. I don't know whether you remember this or not. Okay, so if certain parameters are satisfied, we could say reporting entity ka functional currency and foreign entity ka or foreign operation ka functional currency will be same. If certain parameters are satisfied, we say reporting enterprise ka and foreign operation ka functional currency will be same. So what are those foreign functional currency? This I used to give the example as father and son 1 and son 2. Udupi restaurant example, if you remember, if you have attended my class. Otherwise, it's okay. We'll just look at the parameters. Okay. First is, sir, if reporting entity and foreign operation ka functional currency, if it has to be same, means foreign operation activities should not be run autonomously. Foreign operation should not do the decision. It should not run independently. Foreign operation should be run like an extension of the reporting entity. Like one software. Let's say for Indian entity is developing 50% of the 60% of the software. Balance 40% will be developed by the foreign operation. One software only. First few aspects, like 60% of that software will be completed by Indian entity, reporting entity, and balance 40% will be completed by foreign operation. That means they both are working together. So here foreign operation, though they are situated in another country, it is just like an extension of Indian entity, like that. So the foreign operation activity should not be run independently or autonomously. That is the first condition. Second one, there should be a high volume of transaction or high degree of transaction between reporting entity and foreign operation. A lot of transaction should be going on. What is lot, what is that not defined. You have to take a call based on the case-to-case basis. And the third one is cash flow of foreign operation affects the cash flow of reporting entity. Because cash flow foreign operation will be expected to make the remittance to Indian entity frequently. That's the reason. So whatever cash flow foreign operation makes, that indirectly or directly will affect the reporting entity. That is another parameter. Fourth one, cash flow from foreign operations are not sufficient to fund their operation. Meaning foreign operation does not have enough cash to run their operation. For funding requirements, they are dependent on the reporting entity. If these parameters are satisfied, we say functional currency of the reporting entity and foreign operation will be same. If these are not satisfied, then we say reporting entity and foreign operation of functional currency are not same, like this. So this we used to call in AS 11 terminology. Same indicator was there. This here in AS 11 we used to call this as integral foreign operation. Okay. If these are not satisfied, we used to call it as non-integral foreign operation. Okay. But anyway, that integral, non-integral and all is not there over here. IND AS 21 does not mention that. Okay. All right. Another one is net investment in foreign operation. Sir, if you have any foreign subsidiary or if you have any foreign associate, foreign joint venture, then you need to worry about a little bit. What is that? Is investment. Okay. Sir, in investment, if you think about it, in separate financial statement, how do you value the investment in separate financial statement? IND AS 27 gives the guidance, right? What does IND AS 21 says? IND AS 27 say you can value the investment in subsidiary and all at using cost model or fair value model. Or it says go for cost model or value as per IND AS 109. And IND AS 109 says use FVTPL. Default category is FVTPL. Or if you want, you can go for irrevocable option of FVT-OCI also. Yes or no? Correct? All right. Excuse me. Sir, if you're going for cost model, because this is not an Indian subsidiary, let's say it's a foreign subsidiary. That means you have done a foreign currency transaction, right? So if you're valuing the investment at cost model, then no restatement is necessary. When you buy the investment, that is also an initial transaction. Initially, anyway, you would have used transaction date ka spot rate and converted. Continue with the same. No extra measurement is required. However, if you are valuing the investment in your separate financial statement using FVTPL or FVT-OCI as per IND AS 109, then you're using fair value for your investment. So you have to find out the fair value at every reporting period. Then TDSR will not work. Initially, you have already converted using TDSR, but you're not going for cost model. You're going for fair value model. That means At every year end, whenever you find out fair value, you have to use the exchange rate the day fair value existed. That means you have to remeasure your investment at every reporting period. So further remeasurement is necessary. So you will get some further gain or loss. So what should we do for this gain or loss? Simple. If you're going for FATPL method, what will you do for gain? Transfer it to SPA. If you're going for FATOCI method, gain transfer it to OCI. So that means this Forex gain or loss may go to SPA, OCI or SPL depending on what method. If it is FATOCI, if that investment is valued under FATOCI method, gain or loss you transfer it to OCI. Otherwise, you transfer it off to P&L account like that. Okay. Another one is receivable payable transaction. Let's say parent and subsidiary company. Parent has given a loan to subsidiary company. Okay. Parent is, let's say, there in India. Subsidiary company, let's say, is there in US. Now, parent has given a loan, right? Let's say parent has given a loan of 10 lakh Indian rupees. Okay. That means in parent's books, they will show the loan of what, sir? They will show loan as a financial asset of 10 lakh rupees. But will subsidiary obviously will show this as a liability, financial liability, correct? Because they have a contractual obligation to receive cash or pay cash, etc. Correct? But subsidiary cannot show 10 lakh because this 10 lakh rupees is in Indian rupees. Subsidiary ka functional currency is dollars. Subsidiary ka functional currency is dollars. That means they need to convert, correct? No. Let's say they converted this and got it as, let's say, $10,000 or $12,000, whatever. Okay, fine people, like this. So loan is a monetary item. On monetary item, you all have to book gain loss. So that means the gain subsidiary would have booked some gain loss and this gain loss will be transferred off to SPL account, correct? Now, when you prepare a consolidated financial statement, we have already done consolidation chapter. In consolidation, all this is what, sir? These are intercompany transaction. For one company, it's an asset. For another company, it's a liability. So when you prepare CFS, this both will be knocked off. This financial asset and financial liability, this debtor, creditor or loan given, loan taken will be squashed off. Okay. Sir, if this transaction was done in India, parent would have shown this as 10 lakh Indian rupees. Subsidiary also would show this as 10 lakh Indian rupees. So straight away the transaction would have got squashed off or netted off. Nothing would have happened. But since this one is there, one entity is there in India, another entity is there in US, and they are showing this transaction at different currencies, there will be some exchange gain or loss, right? This particular loan given, this loan taken, loan given, sir, it's an intercompany transaction. This will get knocked off. You will not show this in consolidated financial statement, but subsidiary would have booked some gain. No, there's a monetary item. On monetary item, the subsidiary company would have booked some gain or loss. This gain loss that they have booked, that will get knocked off, correct? Because subsidiary parent has not booked any corresponding loss. Only subsidiary has booked some gain or loss, whatever, correct or no? Yes. So this gain or loss, no, sir, will appear in a consolidated financial statement. That's what we're talking about. I've taken an example of loan. It could be debtor, creditor, bill receivable, bills payable transaction also. Okay. That particular component, debtor and creditor will get squashed off. Loan given, loan taken will be squashed off. Bills receivable, bills payable will be squashed off. We're not talking about that. We're talking about since you're remeasuring that monetary item, you will get some gain loss. And subsidiary company, or for that matter, parent company, would have booked some gain loss on this remeasurement. That will come in consolidated financial statement. So where should we show this gain or loss is the question. Okay. For that, first you need to check the intention of what, sir? Intention to recover. Now here parent has given a loan to subsidiary. You know, if a company, if they have the intention to recover, first you need to check whether they have intention to recover or they have no intention to recover. Like sometimes what happens is parent will give a loan and tells the subsidiary, it's okay, you keep it, we'll see it later. You don't have to pay. Because anyway, parent only controls subsidiary company, no? So parent may not expect any repayment from subsidiary company. That means parent has no intention to recover this. If parent has no intention to recover this, then this gain or loss, no, you will show in consolidated financial statement, this gain will be shown in OCI and it's a reclassifiable gain. Meaning, it's a reclassifiable gain. I'll talk about more about that. Okay. However, if we do have an intention to recover, then this gain will come in consolidated financial statement in P&L account. If you have intention to recover in SPL, otherwise in OCI. And there's a reclassifiable OCI, meaning at some point of time from OCI, it will be transferred to P&L. What point of time? When you lose control over subsidiary. If parent loses control over subsidiary, then loss of control accounting we have already seen. Yes. So then this particular OCI will be transferred off from OCI to P&L account. It will be transferred. Fair enough, people? That is one. So here parent has already booked the gain. No. Where will parent book? Parent means, rather subsidiary. Subsidiary company, where will they book? In their separate financial statement? In their separate. See, in loan given, loan taken is an intercompany transaction. It will get knocked off where? In consolidated financial statement. In separate financial statement, on converting, subsidiary company would have accounted this gain. Where they would have accounted this gain? SPL. So in separate financial statement, mein monetary item, this is a monetary item. Monetary item gain will always come in SPL only. Okay, that there is no doubt. Here we are more specifically talking about consolidated financial statement. That is based on the intention of recovery. Is that okay? Once, just to be sure, I'll recap this. Okay, so if there is any intercompany transaction like debtor, creditor, loan given, loan taken happening between parent and subsidiary company and all, when you prepare consolidated financial statement, that will be getting knocked off. Those transactions will not appear. But since the parent and subsidiary company functional currency is different, okay, so one company would have booked some exchange gain or loss on this. That exchange gain or loss would still be there. That will not get knocked off, meaning that exchange gain or loss will appear in consolidated financial statement. The question is where it will come, whether it will come in SPL section or OCI section, because there's a gain, right? So that is based on intention to recovery. If there is any intention to recover, here parent has given a loan to subsidiary. So if parent has the intention to recover, then this gain or loss will be transferred in consolidated financial statement to P&L. If there is no intention to recover, then this gain or loss will be parked in OCI. And there's a reclassifiable OCI like that. However, in separate financial statement, there is no extra drama. There's a monetary item. And what IND AS 21 says, any gain loss on monetary item should be transferred to P&L. So in separate financial statement, the gain loss will always come to P&L. The question was only on the consolidated financial statement. This we call it as net investment in foreign operation. That's all done. Okay. All right. We have only 2-3. Then we can dive into the questions. Not much here. Okay. The next one is first aspect of IND AS 21 that you need to worry about is the conversion. Okay, first is, in fact, IND AS 21 the major scope of IND AS 21 as per our syllabus is concerned is, one is the foreign currency transaction. If you have any foreign currency transaction, what to do? Another one is translation. So the two main focus for our syllabus or exams per se is, the one is the transaction. If you have foreign currency transaction, what to do, which we've already covered. Monetary item, non-monetary item and all we saw, no, that is one. Another one is translation. If you have any foreign operation like subsidiary company, etc., how do we translate that? Okay, that is the second aspect. So this particular chart covers the translation part of IND AS 21. Okay, so first, before you translate, so obviously, let's say parent is there in India, subsidiary company is there in US, correct? So that means parent ka functional currency is Indian rupees, subsidiary ka functional currency, let's assume it as dollars. So when you have to prepare, when parent has to prepare consolidated financial statement, they need parent ka FS and they have to add this with the subsidiary ka financial statement. Straight away can we add? No. Parent ka data is there in Indian rupees. Subsidiary ka data is there in dollars. Can we straight away add? Not possible. That means subsidiary ka data you need to convert from dollar to Indian rupees. So that is what we're talking about, translation. So how do we translate that from foreign currency to the functional currency of the parent? That's what we're worried about. For that, you need to know some rules, what exchange rate to use, blah, 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 blah. That we are discussing now. Okay. So first you just check if foreign operation ka functional currency and reporting entity ka functional currency, is it same? Sometimes it could be. Yes. So if foreign operation ka and reporting entity ka functional currency, if it is same, that means no drama, no. Correct? Because Indian entity ka functional currency is also INR, foreign operation ka functional currency is also INR, means books would have anyway maintained in functional currency. That means no extra data will come. So straight away take it. If they are maintaining their books in functional currency in INR, parent is also maintaining data in INR. So straight away add. No conversion drama at all. Correct? But sometimes what happens in exams, I mean to say, okay. So functional currency may be same, but presentation currency. Sir, like let's say I'm in India now. My functional currency may be dollars. Just because my functional currency is there in dollars, can I give my dollar ka financial statements with ROC? Can I file dollar financial statement with ROC to income tax department and all? What will they say, right? You're there in India means present financial statement in Indian rupees. So sometimes what happens means if though functional currency of both the entities is same, if in the question, if they give presentation currency, if the question if they give you financial statements prepared in presentation currency will be your local currency, no? That means you need to convert. How do we need to convert? Conversion rules is same as is given in 4. 4 is this that we discussed. Okay. Like all monetary item, you converted it, closing rate. All non-monetary item, if you are using cost model, use TDSR. Okay. Transaction rate ka spot rate, no remeasurement is necessary. If you are using fair value, use the exchange rate on the day you found out fair value and you will get some gain loss. Do the gain loss as per the respective IND AS. That wala, this particular is your rules. The same rules you will apply over here. Most probably this will not come in exam. Okay. I've just given, most probably this will not come. This is not so popular. Another one is popular where foreign operation ka functional currency and a reporting entity ka functional currency, if it is not same. Like functional currency of parent is Indian rupees and subsidiary is something else. In that case, what to do? First is all assets and liability, functional currency of both the things are, if it is not same, all assets and liability, doesn't matter whether it is a monetary or non-monetary item, all assets and liability will be converted at closing rate. And all income and expenses, usually in these sort of problems, they'll give you a trial balance. So you'll have asset, liability, income, expense, everything. So asset and liability doesn't matter whether it is monetary or non-monetary, you will convert it at closing rate. All income and expenses, you'll convert it at average rate. You need the transaction date, rate, that will be mostly not available. So you'll use the average rate. For income and expenses, average rate. For assets and liability, for all assets and liability, average rate. Okay. So when you convert this trial balance, you're not converting at same rate. For one, you're using average. For another one, you're using a closing rate. So trial balance will not match. There will be a difference. The difference you will accumulate in one reserve called FCTR, Foreign Currency Translation Reserve. And this is an OCA. Okay. Foreign Currency Translation Reserve is an OCA and it's a reclassifiable OCA. So how long it will stay in OCA? It's a reclassifiable means sometimes it has to come to SPL. When you lose control, when this foreign operation is disposed or sold, then from OCI, it will be transferred off to P&L account, like that. Till then, it will stay in OCI. Till then, it will stay in FCTR OCI itself. Okay, that is one. Okay, this is popular in examination. All right. And this foreign operation, it's not necessary, it has to be subsidiary. It could be an associate, joint venture, branch, whatever. Okay, probably in examination, this is more popular. Okay, what if the foreign operation is subsidiary? What if the foreign operation is subsidiary and subsidiary ka functional currency same as parent ka functional currency? I think this will not be same. I mean, this is not so popular. If this is same means apply 4 ka rules. We have already seen 4 ka rules. Apply that. This most probably is not come in examination, so I'll not dive into much into that. This probably is more important. We have some questions on this. I'll take you through. What if subsidiary ka functional currency and parent ka functional currency, if it is not same? Subsidiary ka functional currency and parent ka functional currency, if it is not same, in that case, what to do? Same thing what we discussed. All assets and liability you converted at closing rate. All income and expenses you convert using average rate. Okay, fair enough. That is one. So you will get some difference. You will park it in FCTR. All that drama is same. Okay, so fine. I know maybe one more point also I can tell you. So FCTR is related to subsidiary ka conversion. Sir, we have already done consolidation. Whenever you get post-acquisition profit or subsidiary, what do you do? Any post-acquisition profit or subsidiary company, what do? You distribute among what? Parent and NCI. So this particular NCI, what you get also will be given to both parent and NCI. That is one. Okay. And this is a usual one. All assets and liability closing rate, income and expenses at average rate. FCTR, give it to parent and NCI. More importantly, the important aspect is what do you do for goodwill? Because when you get control over subsidiary, you will also account goodwill, right? How will you show this goodwill? What if you acquired a foreign subsidiary in the current year and if you get goodwill, how will you show the goodwill, sir? Sir, goodwill or bargain purchase gain should be shown at closing rate. But sir, we would have got the control at year beginning. No, yeah. Suppose you got the control at year beginning. So first to find, let's say there's a foreign subsidiary and there's foreign subsidiary ka functional currency is dollars. Don't find the goodwill value in Indian rupees. Let's say parent ka functional currency is Indian rupees, subsidiary ka functional currency is dollars. What you do is find out when parent gets the control over subsidiary company, you calculate goodwill. No, don't calculate goodwill in INR. Calculate the goodwill in dollars. This goodwill you have to show in your consolidated financial statement. No, then from dollar you convert it into INR using what? Closing rate. This is what we have written. First, find out the goodwill in dollars only. Because first only if you find it in INR, you will be using transaction rate ka spot rate. Okay, but goodwill needs to be shown at closing rate. That's the reason. First, find out the goodwill in dollars. Anyway, you show goodwill at the end of the year in consolidated financial statement. No? From dollar, later on you convert it to INR using closing rate. That's a fund. Okay, sir. So this is the steps that you need to follow. This could be quite important from examination perspective and you need to remember the rules. They will not tell you for what component, what exchange rate to use and all. They will not tell you. Need to remember. And it's same only. In fact, yes, looks bari. But once you go through this, I feel it's easily managed according to me. Okay. All right, don't worry, we'll directly dive into the questions. I know that once you apply all this in problems, these rules, you tend to remember it for a lot longer duration. So all this requires a little more practice. Yeah. But yes, now if you have a shortage of time, it's all right. We'll try to revise as much as possible through this theory only and try to make do. But if you have time, I suggest do practice all this so that you tend to remember. Okay. FR that way is little voluminous. The paper may not be that difficult. Maybe 1 or 2 attempts may generally paper of FR may come out of the blue. Okay. You normally hear people telling direct tax paper is tough, SFM paper was tough and all that stuff. Less number of people will say FR paper was tough. Major complaint of many students of FR is, sir, FR is very voluminous. Sir. Yeah, definitely it is voluminous. No doubt about that. Since it is too voluminous, no study generally ICA so far what I have seen, they make the paper pretty decent. It will not be too much out of the box because anyway syllabus is vast. ICA knows that many students will not cover the syllabus entirely. Some portion anyway they would have missed out. So institute has an advantage in that regard because of the sheer volume of the syllabus. It is probably the biggest as far as I am concerned. Yeah, all right, but it's okay. But it is not that it is too tough. One or two times if you practice all this, it will stay in your mind and it could be a good scoring subject also. Anyways, that I'll leave it to you. Yeah, I hope that you do get good marks in FR. Personally, I'm an FR teacher, so obviously, I want the students to score marks high. I want you to pass the examination, but also score a little high, more marks in FR. That will make me feel a little better that I have done my justice. Yeah, I like that. Okay, coming back to the next thing, which is disposal of foreign operation. So, what if you have sold off the foreign operation? That could be subsidiary, joint venture, associate, or whatever. So first check whether it's a full disposal or a partial disposal. If it's a full disposal, what do you do, sir? Any FCTR that you have recognized, transfer it off to P&L. FCTR is an OCI, correct? So if you have sold off full subsidiary or if you have lost significant influence, doesn't matter. Then whatever balance was there in FCTR, transfer it off to SPL because this is a recyclable OCI. Or if you have done a partial disposal, then check whether it's a loss of control. Because sometimes, let's say you had 70% stake, you sold off, let's say 50%. In 70, let's say you sold off 50% means now you lost control. No? So though it's a partial disposal, you still lost the control. So if it is loss of control means still entire FCTR, you transfer it off to P&L like that. Because the moment you lost control, all the OCI balance, you'll transfer it to, if it's a reclassifiable OCI, you'll transfer it to P&L. If it's a non-reclassifiable OCI, you'll transfer it off to retained earnings. So loss of control, voila, accounting this is. Yes. Sir, what if that foreign operation is an associate? If it's an associate, it's the same drama. First check, okay, or maybe I think I'll just go for this. So if you have done a partial disposal, first check whether it is a loss of control. If it's a loss of control, transfer entire balance of FCTR to P&L. If it is not a loss of control, let's say you had 70%, you sold only 10%. That means how much you still have? 60%. That means have you lost control? No, control is still there. Then proportionate of FCTR balance you transfer to NCI. You still have control, no? Correct? Earlier you had let's say 70% share in FCTR and so NCI had 30% share. Now you sold off 10% means NCI balance will increase. No? So the 10% of FCTR balance, you straight away transfer it off to non-controlling interest. Their share will increase like that. Okay. Sir, why we don't do that in case of loss of control accounting? Sir, when you lose control, we don't show NCI at all. That's the reason. When you still have control, proportionate FCTR balance, you transfer it to NCI. But the moment you lose control, we don't show NCI only. So full NCI will be derecognized. That's the reason we transfer entire FCTR balance to P&L account in loss of control accounting or in case of full disposal. Okay, that's the thing. Okay, the next one is what if this foreign operation is an associate? If an associate also same thing. First check, have you lost a significant influence? If you have lost significant influence due to full disposal or partial disposal, whatever be the case. Okay, let's say you had 30%. If you sell off 25%, it's a partial disposal because 5% is still remaining with you. But significant influence you lost. So if you have lost significant influence due to full disposal or partial disposal, whatever FCTR balance you have, you transfer it off to P&L. Okay, full FCTR balance, you transfer it to P&L because you lost control. Okay, like that. However, if you don't have lost control, let's say you had 50%, you sold off only 3%. That means you still have 27%, correct? So you still have SI. If you still have SI, only 3% of FCTR, the proportionate FCTR balance, you transfer it to P&L account. If you have lost significant influence, full FCTR you transfer it to P&L because now there is no concept of NCI. Here in associate, parent would have recognized only their share of FCTR. Okay. So in case of loss of significant influence, entire FCTR balance you transfer it to P&L. Okay. However, if you have sold some stake, but still significant influence is not lost, meaning significant influence you still have. In that case, proportionate FCTR only you transfer from FCTR to P&L account. That will accounting. Okay, Saru. Yes. Now let's do a thing and maybe one more we'll cover off. If I do this, then we'll have only problems. Then we'll try to recap the concepts with the help of problem only. Another one is same thing we'll also discuss in IND AS 101. First time adoption also the same concept will come. But no problem. Here it's come. So we'll quickly discuss this. Long-term foreign currency monetary item. Suppose if you have any long-term foreign currency loan, like a company wants a loan, they did not take the loan in India. They took a loan from a foreign country. So if it's a foreign currency loan, okay, then check for what purpose that loan is utilized for. If a company has taken a foreign currency loan means obviously they will utilize it for some purpose. Check for what purpose that loan is utilized for. if that loan is utilized to purchase or construct a depreciable property, plant and equipment. If that loan is utilized either to construct or purchase or acquire a depreciable property, plant and equipment, depreciable fixed assets, then normally loan, sir, is a monetary item. On monetary item ka gain loss, where it should go? To P&L account. But here, no, sir, there is a para 46A exemption of AS 11. You have learned this in AS CA intermediate, if you remember. Okay, AS 11. This is an AS 11 ka para 46A exemption. What AS 11 says is, if you have any foreign currency loan, and if that loan is used to buy any depreciable assets, then the exchange loss, or we do this statement primarily for exchange loss. That's the reason I'm making that statement only in that regard. So if you have any exchange loss on that foreign currency loan, ideally it should be transferred where? To P&L account. No, you need not do that. You can utilize para 46A exemption of AS 11 and transfer it or capitalize to the cost of the asset. The exchange loss, instead of transferring it to P&L account, you can add it to the cost of the asset, meaning you can capitalize it. This is para 46A exemption of AS 11. I told you the logic of this in inter-class. Now we don't have so much time, so I'll not go into all this stuff. Okay. Yes. So this is the thing. Fine. So we are not following AS. No, we are following IND AS. Yeah, I'll come to that. First, let me finish this. So if you have any, first I'll repeat this once again. If you have any foreign currency loan, this could be important. It may be tested here or as an IND AS 101 question also. It's a common concept. So again, listen to this carefully. If you have any foreign currency loan, first check for what purpose that loan is utilized for. If it is used for depreciable asset, then instead of transferring, since foreign currency loan is a monetary item, you have to restate it. So when you restate it at closing rate, you will end up getting some gain or loss. That gain or loss on this specific loan only, not every monetary item, only on this monetary item ka gain loss, instead of transferring it to P&L, you can add it to the cost of the asset. That is one. Sir, I did not use this loan to buy an asset. I have used it for some other purpose. In that case, what to do? In that case, that exchange gain loss, still you need not transfer it to P&L. You can accumulate in one reserve called FCMI TD or FCMI TR, foreign currency monetary item translation reserve or foreign currency monetary item translation difference. You can call FCMI TR or FCMI TD. Some books will call it FTR or TD. It's okay. Foreign currency monetary item translation reserve or translation difference. Okay. So you can park this in one reserve. And from FCMI TD or FCMI TR, it will go to P&L over the loan duration. If the loan term is 5 years, then for over a period of 5 years from FCMI TD or FCMI TR, you will transfer it to P&L on a straight line basis. That is what fund. Okay, sir. But this treatment, sir, is not in IND AS 21. This treatment is given by AS 11. And what IND AS 21 says is, now initially companies will be following accounting standards. Later they would have moved to IND AS, correct? IND AS came, it's a recent affair, not so many years also, correct? Let's say one company was utilizing, this is an option, okay, it's not a compulsion. AS 11 gives this option. And AS 11 also tells if you don't want to use this option, then exchange gain or loss, you can transfer it to P&L also. There's an extra option given to the companies. So let's say there was one company, X Limited. For them, initially when they were following AS, they used to do this option. Later on, now they are following IND AS. From AS, they moved to IND AS. What IND AS says is, if you are following this option under AS, even after IND AS, you can follow the same treatment. And this is a carve out, meaning IFRS does not have this option, only IND AS has this option. IFRS says, oh, if it's a monetary item, gain loss compulsorily has to go to P&L only. But only IND AS, for this component only, it has given a relaxation. Hence, this is a carve out. Okay. Fair enough. I'll repeat it once just to be sure. If you are following, if companies were doing this treatment as per AS, if they were following the above treatment as per AS, even after IND AS applicability, they can continue to follow the same. The choice is there with the company. Or if they want, they can disregard that. They can stop doing this and transfer gain loss to P&L also. That choice is also there. Okay. Or they can continue with that. That's that option. That first time adoption, you will see the same provision in IND AS 101, first time adoption also. So hence, this is a carve out. Okay, sir. Great, sir. Okay, so this we have covered all the concepts. Now let's quickly run over all the question relating to this particular standard. Infotech Global Limited has a functional currency US dollars and needs to translate its financial statement into functional currency and presentation currency of Infosys Incorporated local dollars. Okay, they need to do some translation. The parent ka functional currency is local dollars and subsidiary ka is US dollars. Obviously, the many company have country as dollars. No, Australian dollars, we have Singapore dollars, we have like this. Okay, so the problem with parent ka functional currency is local dollars and subsidiary ka functional currency is US dollars. So US ka dollars ka is now, first of all, is parent ka functional currency Here only. Is functional currency of parent and functional currency of subsidiary same? No. No. Sir, dollar same. No. This is what, sir? Local dollars. This is L dollars and this is US dollars. Both are not same. Is Singapore dollar and US dollar same? No. Like that. So here functional currency of parent and subsidiary is not same. That means you need to apply that exchange rules. What is exchange rule? If parent and subsidiary ka functional currency, if it is not same, then all monetary items, all assets and liability. All assets and liability should be converted at closing rate. All income and expenditure at average rate. And any difference you get, when you convert this trial balance, any difference that you get has to be parked in FCTR. And this is an OCI. And what sort of an OCI this is? This is a reclassifiable OCI. That way. So now you need to do a conversion aspect. That's all. Okay. They have given you the assets. Okay. Capital and all, no need to. Capital and opening balance of retained earnings, generally in the problem, they'll only give, no need to convert. See, US dollars is this value, local dollar value, they only give. So take it, no need to convert this again. Okay. Translate the above balance of inflow into local dollars. So you need to convert this from US dollars to local dollars, for which they have given exchange rate. Check this. Share capital and opening retained earnings have been already pre-populated, meaning that it's already been done. You don't have to do anything. Rate at the beginning of the year is 1 local dollars is equal to US dollars 1.12. Average rate is this. For income and expenses, we use average rate. And rate at the end of the year. End of the year means closing rate, right? So for assets and liabilities, here we use closing rate, right? So one thing you need to be careful here is the conversion, how to do it. So whenever you have confusion, because sometimes you have to multiply, sometimes you have to divide. So what you do is simply plug in the cross multiplication or the logic. Like take example this. Closing rate, we'll take. 1 local dollar is equal to 1.13. 1 local dollar is equal to 1.13 US dollars. Okay, one component, let's convert it and get to know, so that we'll get to know whether we have to multiply or whether we have to divide. Josh, don't do that mistake of straight away, I know, don't straight away multiply. One component, just check. Because if it's in Indian rupees versus US dollars, maybe most of us know how to do the conversion. But here they've given local dollars, US dollars and all. No, we may not know. I think you do all this stuff in your SFM. So you must be comfortable. But just to be on the safer side, one, you do it as cross multiplication to avoid the mistake. Now here, property, plant and equipment. Property, plant and equipment is an asset. For all assets, we use closing rate. Okay. So we use closing rate. What is the closing rate? 1 local dollar is equal to 1.03 US dollars. How much is the local dollar value of PP? 50,000. So 50,000 US dollars is equal to how much local dollars? Cross multiply. How much is this? 50 into 1 divided by 1.13. Okay. Now we got to know. That means this 1.13. Now you should not multiply. We should divide. So one, if you get to know, means now it's easy for us. We don't have to do it. So basically you need to do the division. So corresponding value will be what? 44,248. That's what they've done. Okay. For receivable also, simply take 9,35,000 and divide. Divided by what? The closing rate. What is the closing rate? 1.13. So 9,35,000 divided by 1.13. If you do, my calculator is showing 8,27,433.63, which they have converted. Like this, go on converting. For share capital and opening retained earnings, no need to convert. They have only converted. Okay. Next, what, sir? Profit. Profit is your result of income and expenses. So profit for the year, you will convert it using the average rate. So they've used average rate. Accounts payable and accrued liabilities. Accrued liabilities means your outstanding liabilities. That is also liability. All this will be converted using closing rate. So do this. When you convert, obviously the debit side and credit side will not match. There will be a difference. That difference you'll have to accumulate it in FCTR. That's what they've given over here. That's all. Simple conversion, remembering the exchange rate. That's all it is. Okay. All right. The next one. Maybe I'll take up this question only. On 1st April, makers raised a long-term loan from foreign investors. So we have taken a loan. It's a financial liability, right? I think this is IND AS 109 ka and IND AS 21 ka combo question. This is because if you've taken a loan, means loan ka accounting is as per IND AS 109. But if it's a foreign currency loan, for conversion you need to take the help of IND AS 21. So it's a combo. Combo questions. Whenever you see combo questions, sir, play little like revise them once more, because you think logically, right? We have 31 topics in FR put together, but hardly about 10 or 11 questions in totality will come in our paper. 30 topics, okay, but only 11 questions to choose from. So obviously study material will look to combine more topics and try to frame the question. That way they'll be able to test the more range of topics. So this combination questions, I feel personally, is you should place a little more emphasis. They could be a lot more important for examination. Okay, on 1st April, makers raised a long-term loan from foreign investors. The investors subscribed for 6 million foreign currency loan. So the loan value is 6 million. Okay, it incurred a incremental issue cost of foreign currency 2 lakh. So issue cost is nothing but transaction cost. So in case of financial asset, transaction cost you add, but this is a financial liability. So transaction cost should be reduced. So you'll not take 6 million. 6 million is basically, if you have to take it, we'll say 60 lakh for the time being. So 60 lakh minus 2 lakh, it will be 58 lakh. Okay, that's the value. Okay, interest of 6 lakh is payable annually. Okay, the loan is repayable on 31st March 2087, maybe about 6 years time. That's okay. IRR is about 12%. Loan means obviously you need to do ACM table, no sir. For that they've given all this. Okay. So exchange rate they've told is one foreign currency is equal to 2.5 Indian rupees on 1st April. On 31st March, one foreign currency is 2.75. Average rate is 2.42. Functional currency of the group is Indian rupees. Okay. We are an Indian entity. So this is not a translation. This is a foreign currency transaction, right? We have taken a foreign currency loan. That's all. We are an Indian entity. We have taken a loan from foreign currency. That loan now we have to account it. So how do we do the accounting? So simple. First, this is an RTP May 2020 question. So first what you do is, for initial transaction, initially what do you have to do, sir? If there is transaction cost, you need to minus. So 6 million. So don't directly convert it into Indian rupees. I think I showed it to you in one of the previous topic as well. Put up the ACM table always in dollars only. Okay. Don't put it up in Indian rupees directly. Okay. In these sort of problem, put it up in dollars itself, because different components will be converted at different rates. So prepare ACM table not in Indian rupees, and they won't ask you more than, for these sort of question, they'll not ask you ACM table for more than 1 year. Generally 1 year, at best maybe for 2 years, not beyond that. Okay. So first, you have taken a loan of 6 million, that is 60 lakh. There is a transaction cost of 2 lakhs. That means initially the loan balance will be 58 lakh. Correct? Okay, that is one. And you know the ACM table, right? What is it? First is opening balance and then finance charges. Finance charges at effective interest rate of 12% you book. Book it and don't convert it into Indian rupees. Do it in foreign currency itself. So 58 lakh at 12% will be 6,98,000. Then payment. Every year they told you have to pay 6 lakh rupees. So how do you get closing balance? These two plus this one minus. So that will give you 58,96,000. This is not there in Indian rupees. This is there in foreign currency only. So this is the foreign currency. Now, no sir, once you put ACM table in foreign currency, then convert it into Indian rupees. So opening balance. Opening balance means it's the day you did this transaction. And what does our IND AS 21 says? Initially, all transaction, doesn't matter whether it is monetary or non-monetary, has to be converted using the transaction date ka spot rate. So when did you take this loan? 1st April. On 1st April, what was the exchange rate? One foreign currency is equal to 2.5 Indian rupees. So for this, you will use 2.5 as exchange rate. So multiply 58 into 2.5 will become 145 lakhs or 1 crore 45 lakhs. That is one. There's interest. Interest is an item of income and expenditure. For income and expenditure, we use what rate? Average rate. Have they given average rate? Yeah. How much is average rate? One foreign currency is 2.42. So use 2.42 here. 6,96,000 into 2.42 will give you 16,84,320 in Indian rupees. Then you made the payment. Payment is a settlement, no sir. What does IND AS 21 says? All settlement should be done at settlement date ka spot rate. When are you settling? They told you have to pay all this at the end of the year. That's what they said. At the end of the year, what is the closing rate, sir? One foreign currency is 2.75. So the settlement date ka spot rate is 2.75. So multiply these two. You're going to get what is that? 6 into 2.75 is basically 16.5 lakhs. This is okay. So that is the value. All right. Then closing balance. Closing balance. This is what, sir? It's a loan. It's a loan. Correct. So all monetary items should be converted at the year end using what rate? Closing rate. So what is the closing rate? Same 2.75. So multiply. You're going to get 1 crore 62 lakh 14,000. Normally, how do you get closing balance? These two you add. This one you minus. Correct? No. These two you add and this one you minus. Do the same activity. Here, for Indian rupees, you do 145 lakhs plus 16 lakh 84,320 minus 16.5 if you do. You will not get 1 crore 62 lakh 40,000. If you add these two and if you deduct this, you are getting your calci should show you 1 crore 45 lakh. That means financial liability ka value is 1 crore 45 lakh 34,320. But can you show it as 145? No, you need to show it at 162. So currently your financial liability ka value is 145. You need to bring it up to 162. Mind you, this is a liability. So from 145, you need to increase it, means this is an exchange gain or an exchange loss. A liability or increasing. So obviously it's a case of an exchange loss. So the difference between these two, is nothing but your 16,79,680. That is your exchange loss. Now you can use this and pass your entry. What is the entry? Initial entry is bank account debit to financial liability 145 lakhs. Interest, what is the journal entries for? Based on ACM table, you pass normal entries. No, now you pass the entry in Indian rupees. For finance charges, what is the entry? Finance charges account debit to financial liability. Same 16,84,320. Then when you make the monthly payment, yearly payment, the journal entry is financial liability to bank 16.5 lakh. Then there is an exchange loss. So you have to increase the value of financial liability. So it will be exchange loss account debit, and this exchange loss goes off to P&L to financial liability. That's okay. So that is what they've given away. Done, sir. So the trick is don't convert it and do prepare ACM table in Indian rupees. Whenever you have foreign currency loan or any financial liability, if you have taken in foreign currency, put up ACM table in foreign currency itself. And later do this conversion exercise. Based on this conversion, pass the journal entry if they ask you in the problem. If they're not asked, not required. You can express it in words also like this. Choice is yours. Okay. All right. That is one. Next, excuse me. Global Limited, an Indian company, they are acquired on 30th September 70% share capital of Mark. So Global Limited is a parent. They are there in Indian company, so probably their functional currency will be Indian rupees. But they acquired share capital of Mark, an entity registered in Germany. So it's a foreign subsidiary. Okay. The functional currency of Global Limited is rupees. Okay. For this, the fair value of net assets of Mark is 23 million euros. So they've started giving in euros. That means what, sir? Functional currency of this particular Mark Limited is subsidiary company is euros maybe. That means now only you know parent ka and subsidiary ka functional currency, is it same or is it different? It is different. They'll also call it out, but just same. So fair value of net assets they have given. Purchase consideration is 17.5. Exchange rate they have given on 30th September. 30th September is your date of control. And end of the year, 31st March, the end of the year, that is your closing rate they've given. What is at what value goodwill has to be recognized? That's what they're asking. So if they don't mention, if they give you value in obviously euros, I mean subsidiary ka functional currency is euros only. So your first point is what? Parent ka functional currency and subsidiary ka functional currency are not same. And if it is not same, you know the conversion rule. What is that? All assets and liability at closing rate, income and expenses at average rate, right? And then gain or loss you accumulate it in FCTR on conversion. But they're not asking all conversion or translation at all. They have simply asked you goodwill, right? So let's find out the goodwill, whatever they've asked for. First, so but you know this, sir. Goodwill also I told you. Goodwill you have to show it at closing rate. But with goodwill you will not get at the end of the year. Goodwill you will get it on the date of control. Control here is 30th September. So how do we account this? First, find out the goodwill in foreign currency. Then use closing rate and get the goodwill to Indian rupees like that. So don't directly find out goodwill in Indian rupees. First, find out the goodwill in foreign currency. Then use closing rate and then get it to Indian rupees like that. Okay. First is PC. How do normal goodwill wala calculation? How much percentage have you acquired? 70%. How much PC you paid? 17.5 million. So this is given. Okay. Next, NCI. Have they told you have acquired 70% means NCI will be there? Have they told anything about NCI? They have not told. If they don't tell anything, obviously we'll use what method for NCI? PSNA basis. Do you know the value of fair value of net assets? Yes, fair value of net assets is 23 million. So NCI has 30% share in this. 23 ka 30%, which will be 6.9. So deduct fair value of net assets from the rate of control, 23, you will get goodwill. This goodwill is what, sir? This goodwill is in euros and it is on the date of control. That is one. But goodwill, since functional currency of parent and subsidiary is not same, you have to show the goodwill in your books using closing rate. Closing rate means end of the year. What is the end of the year exchange rate? 84. 1 euro is equal to 84 rupees. So this is 1.4 million euros. So closing rate is 84. So multiply these two, you will get goodwill in Indian rupees. That's what they've asked. Okay. Then they'll pass the journal entry for this also. That's what they've done also. Okay. On the date of control, you will record net assets, you will record goodwill. You will write here to cash, to NCI. Yes. No. This is a consolidated financial statement. Business combination can entry this is. Yes. That is what they've given here. Okay. Great. But the thing you need to remember from this component is first find out the goodwill in foreign currency, then use closing rate and bring it to Indian rupees. That's all. Okay, sir. All right. Another question number 17. We will go through this question. On 30th January 20X1, A Limited purchased a machinery for $5,000. So this is not your foreign currency translation. This is your foreign currency normal transaction. So Josh, just because you have know it, everywhere don't apply this thing. So first check whether it's a foreign currency transaction or whether it's a foreign currency translation. So this is your normal. You purchased a foreign asset from foreign country. That's what. Excuse me. Just 1 second. Sir, you purchased a machinery from USA. So there's a simple foreign currency transaction. Okay. On credit basis. Great. A ka functional currency is Indian rupees. So that means you all have to record everything in rupees only. The exchange rate on the date of transaction was $1 is equal to 60. Okay. Sir, you purchased a non-monetary item, that is PP, and you purchased it on a credit basis. That means you have to pay the vendor as in creditor. That creditor is a monetary item, correct? Because how much you need to pay the creditor? $5,000. The value is fixed. That, so when you say value is fixed, it need not be fixed in Indian rupees. Obviously, how much you pay to the creditor is not fixed in Indian rupees, because due to exchange rate fluctuation, how much you will eventually pay to the creditor, we don't know. It may be more or it may be less. But when we say monetary item, we say value is fixed. That value could be fixed in any currency. Here you purchased for $5,000 means we have to pay $5,000 to creditor. So value is fixed in dollars. That is good enough. It need not be fixed in Indian rupees. It could be fixed in any currency. So creditor here is an example of monetary item. PPE here is a non-monetary item, like that. Okay, because once you purchase PPE for $5,000, after a few months its value will not be same. It could be more also, it could be less also. So value fluctuates. It's not fixed in any currency. That is the reason PPE is an example of non-monetary item. So it doesn't matter whether it is a monetary or non-monetary item. Initially, everything will be recorded at transaction date ka spot rate. So pass a journal entry for that. What's the journal entry for machinery purchased on credit? Machinery account debit to creditors. Machinery account. Okay. What 5,000 is the dollars and the transaction date, the exchange rate was 60. So 15 to 60 will give you what, sir? 3 lakh. That is your transaction date ka spot rate. TDSR we have used. That is one. Okay. Let's proceed further. The fair value of the machinery on 31st March was 5,500. Oh, so we are not following cost model for this asset. We are following fair value model. So the fair value has become 5,500, sir. The value from 5,000 it has become 5,500. This is not exchange gain. From 5,000 its value has become 5,500. So this means what, sir? This is your revaluation gain, not your exchange gain. Revaluation gain. From 5,000 it became 5,500 means how much is a gain? $500 is a gain, correct or no? Don't use exchange rate. This is not your exchange gain. This is your revaluation gain. So use your old rate only. Whenever there is revaluation gain, don't use any other rate. Use your TDSR only. What is your TDSR? 60. 500 rupees is the gain, but this gain is in dollars. But we want it in rupees. Use TDSR only, which is 60. So 500 into 60 is how much? So that is 30,000. Correct? The 30,000 is your revaluation gain. First time when you do revaluation, when you get a gain, where will you transfer this to? Revaluation surplus. So what is the entry? Machinery account debit. Where is that? Here. Machinery account debit to revaluation surplus 30,000, 30,000. Like that. Okay. That is one. Fair enough, people? Okay. This is your revaluation gain. Okay. Next, the exchange rate on 31st March. 31st March means your closing rate was 65 rupees. Okay, one second. Sir, if you're following revaluation model means, what does the standard say? Sir, if you have non-monetary item means, you check how are you valuing. If you're valuing at cost model, then you've already converted machinery using TDSR. You've already brought them into Indian rupees. So if you're following cost model, then remeasurement of this particular foreign currency asset is not further necessary. You already converted, no? Same thing you use, go on booking depreciation and show it in balance sheet. That is for cost model. But here are we following cost model? No, we are going for revaluation model. And what does IND AS 21 says? If non-monetary item, if it is valued not at cost model, but on a fair value or any other basis, then on which day did you determine the fair value? On 31st March. That day ka exchange rate you use and you have to remeasure. That means this machinery cannot be shown in the balance sheet at this value. You need to remeasure. At what value? 5,500 is the value of the asset now. Okay, and what is the exchange rate? 65. That means this particular asset, 5,500 into 65, it has to be shown at 3,57,500. Okay, now this particular PP has to be shown in the balance sheet using the fair value exchange rate, which is 65. So it will come in your balance sheet at 357,500. I'm ignoring the depreciation part and all that. Okay, sir, that is one. Currently check how much is its value. 3 lakh you debited. Here again, due to revaluation surplus, you debited 30,000. That means currently it is shown at 3,30,000. From 330, you need to increase it to 357,500. So how much is the increase more? You have to increase it by 27,500 more. This 27,500 is not revaluation gain. It is exchange gain. It is your exchange gain. So you have to increase the asset, but this is an exchange gain wala things. You have to increase. No, so it is an asset value. If you have to increase means obviously it's a gain. So what is the journal entry? You write machinery account debit 27,500. What will you credit? What does IND AS 21 says? Exchange gain or loss is as per respective IND AS. What does IND AS say? When you do a fair value, when you do a revaluation model, if you get a gain, what you should do for that? You have to transfer it to revaluation surplus. That means this exchange gain will not be transferred to P&L. It will be rather transferred to revaluation surplus only. So again, you will pass one more entry. Machinery account debit to revaluation surplus. How much? 27,500. So you will pass this. This is your exchange gain. Done now. This is for the machinery. What about creditors? Creditor is a monetary item, no? So monetary item should be shown in your balance sheet at closing rate. What is the closing rate? Closing rate is 65. But the day you bought, it was 60. So currently you are showing the creditor at 60, but you have to show it at 65. That means creditor ka balance you need to increase by what's 5. And total for $1 you have to increase it by 5 rupees. So on $5,000, how much is the increase? 25,000, like that. Or simply you can say creditor has to be shown at 65 and 5,000 is the value of creditor. So 65 into 5,000 is how much? 3,25,000. So creditor should come in your balance sheet at 325. But currently it is accounted at 3 lakh. So from 3 lakh you need to increase it to 325. Or directly you can do it like this also if you're comfortable. So basically creditor balance you need to increase by 25,000. So liability balance if you have to increase means it's an exchange loss. So what is the journal entry? P&L account. This is a monetary item ka gain loss. Monetary item ka gain loss where it will go? P&L account. So P&L account debit to creditor, which is 25,000, 25,000. This is a creditor, you convert, that's what I've written here. Creditors being a monetary item, you have to convert using closing rate, and any exchange gain loss you get is will be transferred off to P&L account. This was for the first year. Okay, sir. And if you just check, they've also given a tax rate. Whenever they've given a tax rate, they'll, even if they don't say anything, sir, there will always be a hidden adjustment of DTA, DTL. Okay, do not forget that. The moment they bring in tax rate, what the examiner is looking for you is DTA or DTL. What is that DTA, DTL, sir? Sir, all this revaluation, exchange gain, loss and all, no, is IND AS terminology. It's accounting headache. Tax and all doesn't have all this. What tax is? You bought the asset for how much value? 5,000. When you bought it, what was the exchange rate? 60. That means in your tax books, no. Here, like, maybe I'll write it over here. I think I've already written, not written. No? Okay. So tax base, your carrying amount, what is the actual carrying amount of this asset? 3,57,500. After all this revaluation gain, exchange gain and all, PPE has become 3,57,500. But tax base mein, this revaluation headache, exchange gain ka headache and all is not there. Initially you bought it for $5,000. On that day its value was, exchange rate was 60 rupees. That means tax base, as per tax record, you will be able to claim depreciation on this asset only for 3 lakh rupees. Okay, that means there is a difference. What is the difference here? 57,500. Okay, so we know the equation already. If carrying amount is greater than tax base, what do we need to create? We need to create deferred tax liability. I'll tell you the logic of this also after today only. I'll take up that topic, but for now I'll just continue with this. So if carrying amount of the asset, this asset ka equation, right? If it is greater than tax base, then it is deferred tax liability. How much is the difference? 57,500. We don't create DTA, DTL on the difference. We take the difference and multiply tax rate. What is the tax rate here? 30%. Into 30% if you do, you're going to get 17,250. That is what you need to create DTA for. Or in simple terms, if you don't want to do all this, he already knows this. Asset increased by 30,000 due to revaluation. Asset increased by 27,500 due to exchange gain. All this concept is not there in tax. That means asset value is increasing by these two amount. Means directly you can take 57,500 and multiply 30%. No need to prepare any working note. That is your deferred tax liability. But the problem is, what is the journal entry for deferred tax liability? The liability means you have to create one liability means you will credit. So deferred tax liability you will credit. What will you debit? What IND AS 12 says is, if deferred tax liability has come due to P&L items, then you use P&L to create DTA or DTL. However, if DTA, DTL has come due to OCI item, then you create DTA, DTL using OCI. Now here all this has come, all this 30,000, 27,500 have you transferred to P&L or OCI? OCI. That means what, sir? You will use OCI only to create deferred tax liability, like that. Whichever component this has leading to DTA, DTL, same component has to be used for the creation of DTA, DTL. Here OCI component is leading to DTL. So that's the reason you will use OCI only to create deferred tax liability. So which OCI? Revaluation reserve. So the journal entry you will pass is revaluation reserve or revaluation surplus account debit to deferred tax liability. Okay, that is the drama for the first year. Okay, next year what happened? I think they did not stop there. The exchange rate on 31st March 20x2. So 31st March 20x1, year 1 over. Next year on 31st March 20x2, you made the payment of the payment over supplier was made on 31st March 20x2 and the exchange rate was $1 is equal to 67. We settled the creditor on 67. Okay, that is one. Okay, so now settlement is done. Now what's the journal entry and what does IND AS 21 says? All settlement should be done at settlement date ka spot rate. Okay, so creditor is shown in your books at what value now? Initially you credited by 3 lakh, then you credited by 25,000. So creditor ka balance is 3,25,000. But how much will you credit back? $5,000 you need to pay. Okay, settlement. Now settlement should be done at settlement date ka spot rate. Settlement date ka spot rate was 67. So $1 was 67. That means you have to pay 3,35,000. You have to pay 335, but creditor you have shown only at 325. So there is a difference. Where is the difference? 10,000. That will be transferred off to P&L account. Okay. For settlement, use settlement date ka spot rate. If there is any gain loss, is again related to monetary item, transfer it off to P&L account. That's all. Okay. That's all, sir. No. You're following revaluation model for PP. No. I mean, second year also you need to revalue. Right now, the asset was shown at, first year you were showing the asset at 65. Second year again you need to revalue. Have they told again some revaluation gain has come? They did not say value increase. That means value is still 5,500 only. Correct? So what about exchange gain? Right? In the first year you were showing it at 65. Second year you have to show it at 67. That means again the dollar value is increased by $2. Correct? No, by $2 it has increased. And what was the value of the fixed asset now? It's not 5,000. It has become 5,500. They already told. Though you bought it for 5,000, its value has become 5,500. Okay. So the value of PP is 5,500 now. And from 65 it has become 67 means there is again, you have to show the asset now. You have to show this particular asset. This particular PP will be reflected again in the second year using closing rate, which is 67. So 5,500 into 67 if you do, which will be what? 3 lakh, 5,500 into 67 if you do, you will get 3,68,500. But currently till the last year, this PP was shown at 357,500. So minus 357,500 if you do. So how much will be that? That will be 11,000. That's again, you have to increase the PP by 11,000. This is not due to revaluation gain. This is due to exchange gain. Or simply you can take 2 into 11,000, 5,500, which will be 11,000. From 65, it became 67. No. So 2 rupees increase. Okay. Right? Multiply by the number of value of that, which is 5,500. Directly also you can do, which is 11,000 rupees. So again, you have to write PP account debit to revaluation surplus 11,000. Again, PP increased means second year also you will get deferred tax liability. How much? On this 11,000, tax rate is 30%. So 11,000 into 30% if you do 3,300. Again, carrying amount has increased. Tax base is same. So carrying amount is greater than tax base. So again, create deferred tax liability. Hence, since it's an OCI related deferred tax liability, again the journal entry will be revaluation surplus to deferred tax liability. That all a drama this is. Okay, G. Han G. Next G. Okay, this one particular question. There's an MTP question. It looks very, very big, but it looks very, very simple. Okay, same rule. They've given parent ka and then given ka subsidiary ka. Both ka functional currency is not same. That means what is the rule? All monetary and non-monetary item at closing rate, income and expenses, average rate. That's all you need to do over here. This problem looks 1 page, solution looks 2 page. Okay, because they've given whole balance sheet. And you also need to tell what components are this. Share capital is a non-monetary item. All reserves and surplus are non-monetary item, including retained earnings. Current year profit is, you use average rate. Okay, all right. But if you have to classify monetary, non-monetary, everything you will classify as non-monetary item. Deferred tax liability is also non-monetary item because it is a bookish one. It's not really an asset or liability. It's just a timing asset and liability. So they've asked you to classify each component as monetary, non-monetary. For that, you can quickly run through this. Okay, 1 second. Anything else I'll just say? Yeah, other than that, pretty straightforward. Okay, and maybe one is a debtor. Debtor is what item? Monetary item. They've also given allowance for doubtful trade receivable, meaning provision for doubtful debts. Provision for doubtful debts, what do you do? Provision for doubtful debts, we reduce it from debtor balance, correct? Since debtor is a monetary item, this provision for doubtful debts also you will classify it as a monetary item itself. Okay. Then the component of conversion, all assets and liability closing rate. Okay. For share capital and all, they only told in the problem use historical rate. They only told, so we have used that. For retained earnings, this is your current year profit, so we are using average rate. That's all. When you convert it, since subsidiary ka functional currency, parent ka functional currency, if it is not same, so whatever difference you get, we park it in FCTR. That's all is this question all about. Okay. So you can just go through this once just to be on the safer side. But looks big, conceptually not so big. Okay. Yes. So with this particular standard of IND AS 21 also we have completed.